its range, just chopping around a bit. But now all of a sudden, you start seeing the market getting heavy, taking out the low of day, and actually closing a little bit lower, which did surprise me. But I think the reason why I think the reason why we had a little market dump today is because of quad witching, volatility tends to expand. I think one thesis is that somebody might be front running this, and they're kind of jumping ahead, betting on perhaps a downside, or you might be having some people exiting contracts early just in anticipation for it. So that might be the reason why, but that's all speculation. Let's see. Let me look at my notes. Yeah. So if the market does drop, I would watch 3870 on the S&P. If in my opinion, if we have even if we have a little bit more downside, I think that you could buy the dip, and at the very least you'll get a short-term bounce and get out. So yeah, that's something I would take into consideration. That's like one situation that could play out. Otherwise, most likely, in my opinion, I think we'll hold and we could push back up. But yeah, we'll see. We do have rising rates, which is, well, a few weeks before, when we had rising rates initially, that did scare a lot of investors, especially in the tech sector, because the tech sector is not as established as Dow, and they, ideally they need lower rates to borrow money, borrow capital for cheaper. But I don't think we're at a level where it. I don't think we're at a level where the rates are crazy enough where like it's detrimental yet. I think what may be concerning to some people is how quickly the rates are rising. Because if the rates rise slowly over like a period of 6 months, I don't think people will be very concerned, because everyone expects the rates to rise, but a quick rise in rates may cause some panic in the short term for especially tech investors. But like I said, I think it's a little bit overdone. Ideally, we start to stabilize a bit, ease some fears. Maybe bonds need to go down to a certain level where it's actually attractive to some investors, and then maybe you'll see the bond market stabilize. Or perhaps, you could have the Fed. Well, this is very speculative, but perhaps if the Fed buys a longer term bonds, then you'll see stability for sure. But again, I'm not sure if that would actually happen. But yeah, that's something to consider. Otherwise, most likely, we did have the FOMC on Wednesday, so pretty much what they said was they want to keep their rates, their target rates at between 0 and 0.25%. Let's see, what else did they say? Yeah. Right now they do expect mild inflation, which isn't necessarily bad. If you have some inflation, it's actually good for businesses, because the price of their asset, the value of their assets increase, and if the value of their assets increase, they make more profit, and they could pay their workers more, and it's good, and it's good for everybody. obviously, if you have hyperinflation, then that's when you be concerned. But like I said, we're not really at a level where inflation is concerning. I believe we are in a beginning of the beginning of inflation, but how far it would go, I don't, well, I don't know, but I don't think it would be as I don't think it would be very crazy. They could always raise rates and stabilize the economy. If it gets too hot, then they raise rates, and that's when you have a little what's the word? A little fix for the problem. Yeah, so let's see. Yeah, so notes. Yeah, I have to get worried about inflation, raise to slow the economy, make it more. Yeah, so how this works is when the Fed gets worried about inflation, they'll raise the rates, and what that does exactly is it makes it more expensive to borrow. So then you'll see less investment into businesses and housing markets. The housing market will slow down in growth, so that actually has a deflationary effect. So I mean, if one perspective is, there's a lot of well, not a lot, but there's a significant amount of zombie companies. So about I would say about 15% of S&P are zombie companies, which means that they don't have enough to actually pay off their debt levels even now, and they're not really good companies, to put it very simply. If the rates were to increase, then those companies are in trouble. But like I said, as long as you have decent companies, you buy some value stocks, you should be fine. But yeah, I don't think they're going to raise the rates until 2023. That's what they said. And I mean, obviously it could change, but until then, I think should be fine. But when they do raise rates, you want to sell, because that's generally when you have higher rates or expectations of higher rates, that's when the market goes down. And when the rates go lower, that's when the market goes up because of more growth. Let's see. Okay, now I'm going into futures. Let's see. Let's look at NQ first. All right. Obviously, NQ is one of the more affected indices. If you look at S&P and Dow, they are pretty strong and they're still chilling at the all-time highs. But NQ is one of the indices that is lagging behind these, obviously because of rates. We are at the bottom of the consolidation range, so we are at it. It is a key level, so to watch. Ideally, we hold above around 12,700. If we were to drop below 12,700 and hold below it, then yeah, we might be stuck in this little consolidation area, which, then we'll be watching. If we break below the consolidation area, then that would be bad for the Nasdaq. That would mean more downside. But that's just one of the situations that could happen. And that's very early to say. You need to watch the real-time data. So at the current moment, my focus is on this key level. Me personally, I think, like I said, the rates are overdone. The fear about the rates is overdone, and most likely this is just an excuse to take profit on tech stocks. So yeah, that's about it on a Nasdaq. Let's go into S&P futures real quick. Yeah, so like I said, on the S&P, just watch this level on 3870. Below that will be in this little consolidation area, and below this, 3710, that would be area of concern. But I mean, do note that we had a pretty nice reversal off the bottom, right? Because we did drop quite far. Well, not far. I mean, this is relatively a mild pullback compared to the other corrections we had last year. We dropped about a little over 200 points on the S&P 500, but look at how much. Look at how much we recovered from the lows, and we built a decent amount of value up here. So as long as the profile shows that we don't gain acceptance below 3870, so these green value areas, we don't get developing and holding below 3870, then yeah, you might see some downside. But for now, the profile does not show anything to be concerned about. Yeah, so how much time do we have? Okay. Yeah, so I don't have too much more time. I have to do some homework, but let's see. Is there any questions on any swing trades or any stocks that you want me to go over real quickly? Because I could do that real quick before we end. Anyone? Hang on. Okay. Oh, sorry, one sec. This guy asked me about AMD. Let's see. Yeah, so obviously AMD is follows. It's very closely correlated with the Nasdaq. It is a tech stock. I think if you want to play AMD, you can. Okay, well, there's two ways you could play this. If you want to play long term, yeah, I think you can just buy and you could hold and you'll come back and you'll at least triple your money in a few years. But if you want to play more short term, we are at a consolidation area low. You could start here and add all the way down to 75. And if you want to keep your risk tight, you could stop out under 73, 73.80. Yeah, 73.80. Because, I mean, if we gain acceptance below 73.80, obviously there's a pretty big air pocket here. We have a few gaps, no real structure until we get down to 59. So that is something I would put into consideration. But as long as the Nasdaq behaves, I think AMD would have a nice bounce at this level. Sorry, Alan. Well, what were you saying? Yeah. I think it's mostly tech that's getting killed. Well, not killed, but tech is pretty heavy right now because of the rising rates. I think it did cause some the way the rates went up really quickly. I think it caused some fear, a little panic. Um, but something like financials, I think it's rising rates is pretty good. So that's why S&P and Dow barely even moved, I would say, percentage wise. Because yeah, like financials on the Dow, on the not the Dow, sorry, S&P is pretty strong. So S&P is relatively stable. The Dow, they're blue chip stocks. They're very well established companies. So something like rising rates does not concern investors in those stocks because they're well established. You don't need to really, they don't need low rates to grow and succeed. I got a DM asking about Tesla and Nvidia. Okay, so I'll go over Nvidia first. Yeah, so most of these tech stocks, they're following a very similar price action, right? AMD has a very similar chart on the daily. Me personally, I think Nvidia has a decent amount of reward to your risk. I would size accordingly, of course. You don't want to be too heavy and take too much heat if you can't afford it. But it's all about if NASDAQ holds that key level. If it doesn't and it retests, okay, so you could buy here and you could watch if NASDAQ holds that 12,700 level. If we don't hold it, then you could always stop out and revisit this idea probably in the mid 400s when the Nasdaq, if the Nasdaq retests its lows, and your risk will be under here, or if the Nasdaq breaks its lows, then that's when you stop out and be, you can be more nimble because that below this level, there's like a nice pocket too. There's no real strong support. Or you could you could play it more loosely, and you could start adding, and you could add all the way down, and eventually once things stabilize, and it will stabilize because the stock market will eventually go up. That's the edge of the long side, because shorting, for example, it only goes down at you have to have really good timing on shorting. But with longs, as long as you're not using margin, time is on your side. So you could be more loose with this, and you could add down. I mean, this is, even from here, I think it's a really good reward to risk. But yeah, it's really up to you, honestly. All right. Oh, mostly looking in terms of short-term options plays. If you're playing more short-term options plays, then I would be more patient. Just in case we have a little bit more selling next week, I would not enter any options trades right now. Yeah, so if you're playing options on Nvidia and Tesla, I would be more patient for sure. Wait for like a ridiculous move, because we are pulling back, but we're not. There's not much. If you're playing a shorter term options play, there's not much reward to risk, because if you were to go buy options, let's say mid 600s, you got so much risk to the downside, or what your target would be 700 probably in the short term. It's a bit and yeah, 700 acts as a pretty strong resistance, I would say. So it's not a positive reward to risk ratio actually, but if something like Tesla goes down to and retests this low, then there is more reward to risk. Let's just say your target is 700 and your risk will be below 530, 530, 39. That will give you much more, it will give you a positive reward to risk ratio, because yeah, you either lose a bit here or you make a pretty nice return if it were to bounce. I hope that answers your question. Quad witching impact at market open and throughout the whole day. So with quad witching, I believe we had some front running going on today towards market close. I think people were exiting contracts or shorting betting on volatility expansion because sorry. Yeah, so we had some front running today, and some people probably taking getting out of the contracts ahead of the quad wedging. That's why we had like a nice little dump. But most likely you'll see something. You might see some crazy volatility in the last half an hour into close. You might see some like crazy price action. So that's why I would exercise caution in the last hour of the day for sure. Throughout the day, it really varies. It's hard to say what type of day we'll have during quad witching in the first few hours. So what I recommend is I would play very lightly tomorrow and just be cautious and be patient. Just, yeah, I would go much lighter size so you can lower your risk, is what I'm trying to say. Is there anything else you want me to go over? I have a few more minutes before I have to go. All right, well, if we have no more questions, then we're going to end the session. I will have a footprint class chart, a footprint chart class, probably, I would say next week, I think would work best for everybody. Just let me know what days is the best for you guys, and we could like sort of plan something. Yeah, if you don't know what the footprint chart is, it's basically a look into the candlesticks. So it gives you a microscopic view of the candlestick. It is order flow. So you look at the live bids and offers in each candle. So let's just say I'm on a 5-minute chart. The footprint will basically tell me how many buyers and sellers there are at each price level. And that's, it's pretty cool. You could see the live look inside of what makes a candle and what's happening inside. And it basically gives you more detail to the data. But yeah, anyways, guys, I hope you all have a very nice night, and I will talk to you tomorrow. Thank you.
Thanks, Beck. Appreciate that.
See you, Alan.